Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again David McAlvany. David has a very impressive academic background and a professional career in the financial industry. And from what I know, it isn't only his background and experience and expertise in the markets that he brings him value, brings his clients value, but of equal importance is a culture of honesty and integrity that he has implanted at McAlvany Wealth Management and the other related companies. Along with that integrity comes an ability to think outside of the box that others would always like to enslave us in, it seems. So often anyway, we're not supposed to think, we're just supposed to follow the leaders, as they say. And so it's really great to have David with me again. Thanks for joining me, David.
Jay, great to be with you.
Always good to have you with me, and I've titled today's show, Adjusting Investment Themes to a Weaker Dollar. But before we get more specifically to that show, I'd like to just mention last week on your McAlvany Weekly Commentary podcast, the theme of your discussion was gold's rapid rise. Is it guns, parentheses Iran, or butter, parentheses devaluation? Perhaps you could just talk to us a little bit about the theme of that show and what you talked about, some of the topics that might have gone into last week's podcast. And I'd like to recommend to our listeners that they check in with you, I think, every week, and you've got one coming up tomorrow that will be loaded up on your website, I believe. Is it MWealth? Is it the site to go to is mwealth.com, mwealthm.com?
You know, if you just go to McAlvany.com, you can link to any of our pages, which would include the wealth management or the commentary. So just the last name, McAlvany.com. So guns and butter, the different take on the Johnson administration days. Yeah. We have some concerns about what's developing with Iran. And obviously the idea of devaluation, we got to see the debates, the Democratic primary debates, and it was all a number of ways in which we can spend money that we don't necessarily have to take care of people who have an infinite number of needs. So the potential domestically in terms of fiscal policy is there for devaluation. Competitive valuation in terms of trade could be a theme that develops. What we see in the gold market today is a safe haven bid. It's moving along with treasuries and boons and other paper that's desirable from a safe haven standpoint. And so, you're kind of caught on the horns of a dilemma because on the one hand, gold is getting some interest, and on the other, it's not necessarily the case that it would continue to be with a weak dollar in mind. Yes, over a long period of time, you've got a negative correlation of 0.85 the dollar to gold. So it would make sense that a weak dollar would signify strong gold prices moving forward. But there are periods of time where you see, like we have in recent weeks, safe haven buying of gold, in which case there really is no relationship to the dollar. You could have a strong dollar on the basis of people moving into treasuries because they're yielding more than other central banks, which are yielding less than nothing. Yeah. And at the same time, gold continues to motor higher because it's desirable as a safe haven asset. So I don't think the long-term success or maybe this period of success for gold requires a weaker dollar, although we can certainly make that case.
Yeah, it's actually... Michael Oliver, who was with us during the first segment, pointed out that it's been some time now. I can't remember exactly the time frame in which the dollar has been stable, hasn't gone down, and gold has risen from under 1,200 to where it is now. So it certainly is true. I also would like to mention again, it's for people to listen to your weekly commentary because I think it's so good. It's usually about a half an hour in length, I believe, and I understand that you just recorded another one this morning that will be uploaded on your website tomorrow. Is that right? And if that is right, could you maybe give our listeners a hint of what the topic will be for the one that will be loaded tomorrow?
Sure. It is going to be loaded tomorrow. And we talked about a variety of things. I mean, we're definitely interested in the disconnect between the stock market moving higher and as if there's nothing to be concerned about while you're still seeing lots of traffic into the safe haven assets.
Right.
And so yields continuing to go lower and lower, bond prices continuing to go higher, indicating strong demand. And it just means that you've got investors on the one hand who see no problems on the horizon, and another set of investors who definitely see problems on the horizon. That same divergence between equities and bonds was occurring in 2007, where you began to see yields decline, even while stocks were motoring higher as if it were 1999 all over again. So I think we're setting the stage for a significant decline in equities, and the only guys who are going to be surprised are your equity investors. But as it's been said by many investor professionals before, the equity crowd gets it last.
All right, so it seems to be the case, and you can usually go with the bond markets, I think, long term, and you're probably going to be right. It seems that it's kind of a disconnect that we have here. That would certainly what my thinking is. On your June 21st weekly commentary, not the podcast, but you also have a weekly commentary in which you sort of summarize the week and what's happened and how you see the markets at that point in time. You and your team. You wrote, and I quote, "These are truly remarkable times for hard assets. We are finally beginning to see signs that King Dollar is joining the race to the bottom in a global currency devaluation war." And so I'd like to ask you, what are you seeing that causes you to believe that? Because if we are going to have some sort of a market collapse, I think very often the dollar tends to get stronger, at least in the short run, because people are covering their, the margin clerk calls, and you have to sell assets to gain the cash to pay your debts. So what are you seeing that causes you to believe that the dynamics may be for a decidedly weaker dollar, or just I don't know, what are your views in terms of how much weaker we might see the dollar, and what might be the dynamics that lead to a weaker dollar?
Well, you're right to frame things in terms of short-term and long-term. I think the long road for the dollar is a very weak and painful road. Short-term, it can do anything on a trading basis. But what we see is really a fight for hegemony, and we've maintained the world's reserve currency status for many decades following World War II. We're beginning to see strides towards the rest of the world saying maybe the old monetary regime is not what the new or future monetary regime should be or will be. And, Instex is certainly one move towards tearing apart the advantages we've had being the world's reserve currency. And the main participants in that are the French, the Germans, the British. And these are folks that we consider reliable trade partners and on the same page with in many respects. But they, too, I think, would see dollar reserve status as something that's not as important moving forward. So what would we do to maintain our place in the world? Would we voluntarily engage in a competitive devaluation? It's fascinating to me to listen to Donald Trump because on the one hand, he'll criticize Mario Draghi's policies for weakening the value of the euro and giving them a trade advantage, or for the Chinese for that matter. But if we weaken our currency, somehow that's okay with him. Yeah. So it very, very much a double standard today. And if it brings us an advantage, we will do it. And I think from his vantage point, increasing our share of the global GDP pie may include the choice to devalue. So that's also an opportunity or an option that we may see exercised in the next 4 to 6 years.
Yeah, it's concerning the European relationship that we have had since World War II especially. It seems to me that there is growing discontent with the American policy, certainly towards Iran, for example. And I've read where there's some efforts on the part of Iran and some of the European allies to find a way around the sanctions that President Trump is trying to impose on them, including a way around the SWIFT system or a payment system outside of the SWIFT system. Do you know anything about that? Have you heard or read anything about that?
Yeah, well, that's what I was mentioning with the Instex, INSTEX. That is the workaround for both the trade of goods and commodities, as well as the movement of assets, which circumvents SWIFT. And, we're in the process of going after the Chinese as we speak, 3 banks that are doing business with North Korea. And the threat, the sword, if you will, of Damocles that hangs over the Chinese heads is we're going to cut you out of the flow of capital via the SWIFT system. And the Chinese response is, okay, and if that system proves to be problematic, maybe we just need to engineer our own system. So, we push, And at a certain point, I think we find that the energy we put into pushing could be used against us in almost a sort of jujitsu style move where our energy and our weight are all of a sudden a liability. We're trying to push people around, but it's used against us. And I think that's probably the case with SWIFT moving forward.
Mm-hmm. And I still remember when President Obama was trying to push through the agreement with Iran, and Secretary of State Kerry was warning a group of businessmen that if that treaty wasn't approved or if it didn't go forward, that a lot of the European nations would become very unhappy with this. And he said there was already talk and discontent among our allies about the hegemony of the dollar and how they would like to see it displaced or at least not as dominant as it has been. So yeah, it seems to me that we could really be looking at some major changes, David, in terms of the global monetary system, especially if we have any kind of really serious economic decline again, as we had in 2008, 2009. Wasn't it then when the Chinese and the Russians and others started to look for ways to protect themselves from the next sort of decline that might be coming their way, right?
That's right. It certainly opened their minds to doing things in a different way. In an ironic twist, it would seem that a real outright global depression would shift the balance back towards us. We've got the sort of incumbent advantage. We've got the dollar safe haven status. And if things get bad everywhere else, they're kind of the least worse here in the United States. You've heard the dollar being the cleanest, dirty shirt, as even Ian McAlvany used to describe it, the best looking horse in the glue factory. But truly, in a moment of panic and crisis, what currency do you want to be in? All of a sudden, this underscores our role, the importance of the U.S. dollar. And so real turmoil could be our saving grace, at least in the short run.
So if all the currencies in the world are headed lower, doesn't really matter as long as the dollar isn't the one that goes the most low.
Well, I think for anyone who's not paying attention to real assets, and this is where hard assets and our focus on the wealth management team with hard assets and a focus of cash flow relating to hard assets, or the actual metal himself, our sister business dealing in precious metals brokerage for 47 years now, you see the gradual devaluation, the competitive devaluation, the relative, the absolute loss in currencies when you focus on real things. It's when you're locked in the relative value game where it looks like the dollar's doing better relative to the euro, relative to the yen, but they could all be on a downward slide, just some sliding at a slower pace than others. Well, I think that's the importance of having some sort of reference point, some sort of a plumb line, some sort of an absolute value in the equation so that you know where you're at and don't get sucked into the devaluation game. Mm-hmm.
Yeah, I think there's no doubt about that. I believe in one of your recent podcasts you talked about some of, I think, the Malaysian Prime Minister and other leaders are really seeming to focus on gold and going back to a gold-backed currency, providing that plumb line, as you say, I guess, for the rest of the world. So we have some reference point of value. Do you see a realistic chance of some sort of a commodity-backed monetary system? Do you think that's a reality, or is that just a pipe dream of a lot of gold bugs?
Well, I think when you look at Mahathir Mohamad in Malaysia, he's been a long-term proponent of gold and gold being a part of a currency system, whether it is relating to the Islamic world or it's relating, as he's most recently mentioned, becoming a part of an Asian regional trade currency. So there's nothing new from him. He's long been a fan. There might be an openness to that in Asia for trade-related issues. I think a broad-based acceptance of gold by the central bank community is a low probability because it introduces disciplines into a system where they've come to enjoy the freedoms of really arbitrary decision making. They don't They don't tie their decisions to rules. They pretend to base their decisions on numbers. But the old disciplines of the gold standard are long gone, and they would never voluntarily take them back. So perhaps on the other side of a global currency devaluation, you end up with a return to gold. But it has taken extreme negative circumstances for the man in the street to demand the disciplines, and only then do they come back. That's really the history of the gold standard. Is it's there, it's lost, the paper currency system gets screwed up, and then they demand to bring it back. So popular demand for gold could do it, but we don't have the circumstances or the level of pain experienced by the man on the street necessary to, again, in a sort of populist shift, demand that kind of a discipline. Not yet.
All right, David. So without a plumb line, we can be pretty sure that the purchasing power of currencies around the world will continue to decline. And so that plumb line is gold for many of us. Maybe it's real estate. It's something that's real that can't be devalued away. Recently, I think it was on your June 21st weekly commentary, you provided some ideas about what you as a portfolio manager may be doing in terms of adjusting to a weaker dollar, a dollar that becomes weaker than it has been relative to other currencies. Could you tell our listeners a little bit about what your thinking is? What are some of the sectors? I'm sure gold is one of them, but what are some of the ideas that you have in terms of maybe some good places to put your money in a weaker dollar environment?
Well, this is the challenge, because when you start looking for ways of hedging against a weaker dollar, you tend to move towards commodities, and then you embrace a cyclicality to the pricing of those commodities, which, let's say, for instance, you're 65, 75, 85, or 55 and thinking about retirement, that kind of price cyclicality can be very unnerving. So the key, I think, within the portfolio management space, and what we've tried to do, is focus on income generation, where some of that income is generated to infrastructure and real estate as well as commodities to help balance out the cyclical nature of the commodity movement. And the nice thing about having an income component, let's say you're able to create a yield of between 3 and 5%, is you're being paid to wait, and some of the cyclicality in the commodity pricing is less of an issue because you're moving towards a total return equation. Part of it income, part of it capital gains, versus, frankly, most commodity plays are just beneficial on a capital gains basis. So shifting focus to total returns, shifting focus to income, I think that's the way I would harness some of the energy of those spaces. But again, we want to focus on real things. So imagine the old idea of owning a toll road. Well, okay, it's not gold, but it is a real thing with cash flow. And so if you can target real things that have cash flow in complement to a gold position, now I think you're talking. And now I think you're talking about a portfolio that not only provides growth and upside potential, but again, removes some of the frustrations that come with price cyclicality in just a pure commodities play.
Yeah, so it could be something like a pipeline or something like that could provide. So what are some of the other ideas? I noticed that you talked about lumber, I think, was one of your ideas. Could you talk to us a little bit about what might make lumber attractive?
Yeah, I mean, of course, there's the risk of, are they building houses at a particular point in an economic cycle or business cycle? Are they using, the trees for pulp? Is there as much demand for paper? What I like about timber is that it's something that's growing. Think of it in terms of sort of an internal rate of return at about 7% a year, given the growth in the asset itself. So when you have water, soil, and the wood that's growing, its board footage is growing typically at about a 7% rate. You may not be harvesting it, you may not seeing the benefit, but there is, let's call it, for lack of a better term, organic growth with something like timber. And so over a long period of time, it's a real asset that has an internal growth component. And you can decide when and how to harvest when pricing is more favorable to you.
Let me ask you, with regard to gold, on your June 21st discussion, your written discussion, you said you were cautiously optimistic, and I think gold has performed very nicely since that June 21st comment. What are your thoughts now? Is it overdone a bit in the short run? Do you think we might see a pullback?
Still cautiously optimistic. If you're looking at the charts, certainly break above the 1365 and above 1400. These are helpful points. But what we have yet to see is follow through from silver. The gold-silver ratio as recently as last week was 92 and change. And so without that follow through, it certainly leaves the possibility of kind of a false breakout on gold. And so we'll have to see. We started by talking about gold in terms of the safe haven bid. The buying has neglected silver because silver is not as reliable as a safe haven bid. If you get into a scenario where gold is moving and there's an audience for it, a growing audience, then silver will play catch up. Silver will participate at some point, but there can be periods of time where silver is just not treated the same. It's viewed for its industrial commodity status and not as a purely monetary metal as gold typically is. And so that to me is still concerning. Love to see follow through there. And if you look at the gold mining equities, very little follow through there. For all the move in gold from the 1200s to 1400, you haven't seen the kind of multiplied growth in a lot of your names. Now, there have been a few outperformers, but I think those have earned it on their own management merits and asset merits, not necessarily just as a proxy for the price, as a leveraged proxy for the price. No speculators have really come into the gold share space as of yet, and I would like to see that as a form of investor dollar follow through.
All right, new money coming into the sector would be nice.
Yep.
Does McAlvany Wealth Management, do you as part of your portfolio strategy, own some gold mining companies by any chance?
Absolutely. Yeah. And this is where, it's taken us 5 decades to build an amazing team. And at this point, our team consists of some of the best analysts in the natural resource space, some of the best analysts in the credit space. And so when it comes to both analyzing company-specific opportunities in the natural resource space or recognizing specific risks inherent to the structural issues within the financial system, man, I'm incredibly proud of our wealth management team.
All right, well, we're going to have to leave it go at that because my engineer tells me we're out of time. David, it's so good to have you back again. It sounds like something our listeners should check out. So it's McAlvany.com, I believe is what you told me.
That's right. Or our website for the wealth management group is mwealthm.com. M as in Mary.
mwealthm.com.
That's correct.
Excellent. Very good. Well, thank you so much, David, for being with us. We'll hope to have you back again soon.